Welcome everybody to the April 2025 market update, and this one is titled Market Crash or Healthy Correction. I am Daniel Krug. I'm the CEO and Senior Wealth Manager at Daniel Krug & Associates. I will be your presenter today, and I really want to thank our portfolio research groups for their research and materials provided for this presentation. We have got such a phenomenal research group. Our back office is second to none, really, because we've got so many resources to go to get information. And they have just been fabulous at getting us data so we can make real good decisions from an investment standpoint for our clients. Now, that being said, a lot going on today, a lot going on this week. It's been a very volatile week in the market. The tariffs have been in the news again, and they will be likely for the next 3 months. So you can just expect it to be a little bit volatile for that period of time. But just remember, volatility breeds opportunity, and we are going to take advantage of this opportunity that is put in front of us. So let's move on. First thing I'm going to talk about is the tariff effect. So when you're looking at this chart, this is the S&P 500. It shows the last 3 months of 2024 and the first 3 months of 2025. And you can see that in February, late February, beginning of March, that's when we started seeing the volatility come in, where the market started correcting, and that was from a lot of tariff talks. Most recently, on Wednesday, we had a situation where President Trump put a pause on most tariffs. And what happened to the market? Well, it spiked up 9.52%, and that was the highest one-day jump that I believe is actually recorded. Pretty phenomenal, but it does make it a little bit more challenging when you're trying to implement strategies. I believe even with this bounce up, also based on what Thursday numbers look like, because there was a little bit of volatility yesterday, that we are going to have plenty of opportunity to really execute things like Roth conversions during this time period. Okay, let's take a look at the economic speedometers. Now, these are put out by City National Rockdale, and what you see is two sets of speedometers. You've got March 2025, which was effectively last month, and you've got April of 2025, and you can see there have been some changes in the speedometers. Matter of fact, when you're looking at it, you can see that there's been 8 changes. Most of them were green and now have gone to neutral. And you might ask yourself, why are they neutral? Well, if you look at the highlighted green area where it has monetary policy and U.S. economic outlook, this is what's driving the uncertainty today. With all the tariffs being negotiated, you hear one thing one day, another thing another day, and it's just made it very difficult to look out 6 to 9 months with any kind of certainty to be able to say where we're going to be. And those two indicators right there are really driving the rest of them. You know, consumer sentiment, consumer spending, the labor market, corporate profit growth, what kind of projections are they having there? It's just making things a little bit harder to read long term. Now, that being said, I'm not really worried about it because I believe this is induced because of the confusion right now. Once things settle down and you start seeing the negotiations settle into contracts with each one of the countries out there, I think you'll see the speedometers turn green again. So it's a momentary thing, I believe, but we'll see how it all shakes out. Now, moving forward, one of the things that you're hearing in the news right now, a lot of the media, is that the tariffs are going to be driving inflation, and we're going to be spending a whole lot more because of the tariffs. Well, the question is inflation just tariff driven, or is it overall economy driven? And what I want to show you here, the chart that you can see right now, is the potential inflationary impact of tariffs at different levels. So it starts out in 2018. And if you recall, we had tariffs put on China at that point, which were pretty stiff tariffs. And their concern was that it was going to increase inflation, from a max 0.8%, but minimum 0.16. And as you're looking at this chart and you fast forward to today, if we end up with a 10% tariff on China and 25% on Canada and Mexico, you can see the spread there. Same thing with the last chart, the last part of the chart where it shows 60% tariffs on China and 10% on others. Now, what I want to point out here is this inflationary impact is strictly on the tariff items. It is not on the overall economy. And the problem with the media today is they're talking about just the increase on the tariffs, and they're not showing you the other side of the balance sheet. What do I mean by that? Well, effectively, the tariffs are going to affect about 10% of what we purchase, which leads a whole nother 90% that is not going to be affected by tariffs. And I'll show you this on the other chart. But the overall economy has other things going on right now. Matter of fact, we just got the inflation report on Wednesday that effectively said the year-over-year inflation rate has gone down. The actual was at 2.4, where the forecast was 2.6. So that's good news. You look at it from a month over month, the actual actually went negative 0.1 when the forecast was 0.1. Now, why I mention this is because when you're looking at the overall economy and you look at what the Fed's doing, you look at what the administration is doing, there are factors that are actually driving down inflation right now for the overall economy. And I'll get into a little bit more of that on this next slide here. Now, this slide talks about imports with the largest impact on the PCE core inflation. In other words, how is this going to affect or influence us from a personal consumption expenditure standpoint? And what they have analyzed is it only affects us at about 10%. Now, if let's say, for instance, these areas all went up 10%, let's say there was a full 10% inflationary factor on that 10% of what we consume. Well, if you average it out over everything and nothing else changed, you would end up with a 1% increase in your overall inflation. But the reality is, other things in the economy are actually driving inflation down. So if the other 90% went down 1%, you're actually going to have a decrease in inflation. So be very careful when you're listening to the news. You got to be very mindful of what they're telling you. And if they are not talking about both sides of the balance sheet, you're only getting half of the story. So my point here is, I do not believe the inflation is going to be affected overall. Will it impact these items here that we are using? In other words, items that are actually getting the tariff on it? Yes, it will. But will it effectively impact your overall inflation in a negative way? No, I don't believe that's going to be the case, because there's too many tools in place already that are driving inflation down. Now, let's talk a little bit about what Trump is attempting to do from a global economic reset. So there are 5 main goals of the tariffs. The first is just plain a negotiating tool. It allows people to come to the table so they can negotiate a new deal. The second really is leveling the playing field. And if you think about it, there is a lot of conversation out there about how US is paying a lot more than many of the other countries are. So they're trying to level the playing field a little bit there. Number 3, promote a greater national security. And let's face it, during the pandemic, that was a wake-up call. From a U.S. national security standpoint, they found that we were very vulnerable in technology, shipbuilding, medical care, and they want to bring a lot of the business back to the U.S. So we are not reliant on other countries. Reshoring manufacturing, we've all heard there are billions of dollars coming back into the U.S. that is going to be invested here, which quite frankly is going to help us a lot from a domestic growth standpoint. And then finally, it's also a revenue generator. And it's a revenue generator that doesn't directly tax our country's citizens. So overall, I look at the plan as a positive here. Obviously, we're going to have to see how this whole plays out. Now, let's talk a little bit about, again, hype on the tariff side. If you think about these statements, and all of these statements have been in the news, they really only talk about one side of the story. And again, it goes back to the tariff slice that is going to create inflation or a recession, or goods are going to skyrocket in price. I mean, there's a lot going on there in the news. But the question is, what's the reality here? What's actually going on? Well, the reality is there are exemptions to these tariffs. The first one, which is a big one, is the USMCA compliant trade with Canada and Mexico. In other words, we already have a trade agreement with Mexico and Canada. And that trade agreement isn't being affected by these tariffs. So when you're looking at how it's going to affect us, in addition to the tariffs we already have in place, you'll find that it's not going to be as impactful as most people thought it was going to be. And keep in mind that the tariffs that we have in place exclude, with the exemptions, auto, steel, aluminum, which are already tariffed at 25%. And goods that do not comply with the USMCA are going to be tariffed at a lower rate at 12%. Next, you've got non-Chinese de minimis imports. Now, you might be saying, non-Chinese de minimis, what the heck is that? Well, it's really anything that gets shipped with a value less than $800. If it's coming out of China, it's going to get hit with the tariff. If it comes out from another country, it is not at this point going to get hit by a tariff. So think Amazon and you're getting something shipped from another country. If it's not coming directly from China, you will not get hit with the extra tariff on that. Critical commodities products not made in the U.S., things like bullion, various minerals, energy, copper, semiconductors, lumber, pharmaceuticals, these are exempt from the tariffs. So we're not going to get hit on those. Foreign good imports that include U.S.-made parts, 20% or more, they are going to be exempt. So you start seeing there's a lot of things that we're not going to get hit with, which is why the average citizen is just not going to feel the tariffs like the hype would suggest. Now, let's go a little bit further than that. Again, more reality relative to retaliation. China has placed a 34% reciprocal tariffs on U.S. goods. And by the way, with everything fluctuating the way it is skyrocketed up to over 100% now. But keep in mind that China accounts for only about 6.5% of the total U.S. exports. Again, a smaller number. Canada has placed 25% tariffs on U.S. autos and are not compliant with the USMCA. So again, anything that was under USMCA is not changing and is exempt from the new tariffs. The United Kingdom, well, now they've drawn up an 8,000 item list of goods it might decide to impose tariffs on. It does include things like agricultural, bourbon, which, by the way, Kentucky might like the fact that they put a tariff on bourbon coming out of the United Kingdom, diesel, electric passenger vehicles. All of these are things that the United Kingdom are looking at putting tariffs on. And then finally, the EU will invoke its anti-coercion instrument, which is a regulatory tariff and quota measure, if the US is unwilling to engage in negotiations. Basically, the United States is in negotiations, and I think, again, with this pause that President Trump has put on the tariffs, I think what you're going to find is two things. One, during this pause, there will be negotiation going on behind closed doors. And you might find over this 90 days that you're hearing news come out of the White House that effectively says, we've made a deal, now we can move on with each individual country that they're working with. That would be number one. Number two, Rocky had mentioned it this morning, that there's also the package that President Trump is trying to get through right now for spending. And we're seeing already that there's negotiations going on with Congress to make this deal happen. So a lot of stuff going on behind the scenes, and there's a lot more that's coming. So next item, when we're looking at the overall U.S. economic outlook, first of all, job growth still remains solid. So really no issues there. Wage growth is still steady. Inflation, though still a concern, is moving down in the right direction. And right now is only 0.4% above target. So again, we're in pretty good shape right there. Consumer spending continues to support the economy. And well, it needs to, because it is 70% of the spending out there. Corporate earnings are still reflecting strength. Now, it'll be interesting to see as we go into the earnings seasons how they're going to be projecting out the earnings moving forward, because there is so much uncertainty out there right now. And I want you to really keep in mind that this is an external shock to the system. It's not a structural breakdown like a credit crisis or a systemic failure. This is something that is more induced by the news on the tariffs. So you can see that over time, when it becomes induced, kind of like what happened with COVID, that we tend to pull out of it within a quarter or so. So I think we've got some time where the market is going to kind of work itself through. We may walk sideways for a few months, but I believe it's still going to end up pretty darn good by the end of the year. And I've got another slide here that really will tell the story. There is a poll that gets done periodically, and this one was done on 3/13 and again 4/28, where they look at all non-professional investors and they poll them. And what they're trying to find out is, does the investor feel like things are getting bullish? Is it neutral? Is it bearish? And in this chart, and in the last readings we've had, we've actually had the 8th most negative reading, which actually bodes well. Negative is, in this case, is more contrary, where the latest poll came in at 40.1% on the bull-bear spread. And you can see in the highlighted area that anything from 42 up to 54 projects out that over the next 12 months, the market is likely to be up. And in this case, you go down to the lower right-hand corner and you see the averages over 1 month, 3 month, 6 months, and 12 months. So on average, 12 months later, we're looking at a 27% increase in the market. And I just want you to understand that because this is not a market crash, in other words, something that is systemic, it is likely that this is going to be short term. Short-term corrections, which are healthy corrections, actually bode very well for a longer bull run. So I wouldn't worry about things right now. We're going to take advantage of it. The money manager is going to take advantage of any kind of shifting that we need to do in the accounts. It's going to be okay. I believe it's going to be really good. Now, what to expect moving forward? Again, expect continued volatility. Negotiations take time, but deals eventually get done. So there will be volatility, but don't worry too much about it. Focus on your investment plan. You got to remember that your long-term investment plans are built to withstand these kind of corrections, bear markets, recessions. And stay focused on the long term, because your team at Daniel Krug and Associates does have a plan that is designed based on your portfolio needs. And, just for those that say, yeah, but what if we do go into a bear market? We have a plan for that too. We've done it in the past. We will do it in the future, walking through this, making the decisions as we need to for each individual client's portfolio. So the plan is there. Rest assured, it is going to be taken care of for you. If you do have any questions, please call your advisor. Let them know what your concerns are. And if there's something going on in your life right now that needs immediate attention relative to the market, please call us. So you can certainly go to our website at Daniel Krug and Associates. It's mydkna.com. Click on the Watch Us button, then click on DKNA YouTube, and it'll bring you directly to that YouTube site where you can get snackables or full versions of all the videos that we put out. There is no need to worry. Yeah, we are here to take care of you. We're ready for 2025 and beyond. So you take care of your family, we'll take care of you, and let's just have a great year.